Hi everyone. So welcome to the live stream today. Very much excited for having you on the day 2 of our sessions on looking at practice questions in various areas. Yesterday we looked at the issue in relation to the final accounts in financial reporting, focusing on a couple of standards and how they are going to be treated, or they are going to be treated in the financial statements. And we want to just build up on that today and look at some standards related questions. Today we're going to be focusing on about 5 accounting standards: IAS 20 government grants, IAS 23 borrowing costs, IAS 36 impairment of assets, IFRS 5 assets held for sale and discontinued operation, and then IAS 2 inventory. So we're going to be focusing on these accounting standards, looking at the questions that we have here in order to address them in that case. Now, in case you don't have the questions have been posted already on my Instagram page, and you can get access to the question on my Instagram page at Nhyira Premium. It is also the place that you can follow me at to get updates on whatever it is that we're going to be discussing for each day for our discussion. So welcome to the stream. I see some of you guys joining in. Gabriel Kogu said, good evening, sir. Good evening, Gabriel. I hope you're doing well. And give me a thumbs up on the video when you join the stream, and also consider to share the stream so we can reach as many students as possible watching the stream. So together we can touch a lot of people's lives and assist a lot of people across the country and across the continent. So welcome to the live stream. We're going to be going straight up into the discussion for the day. Right, so from Facebook, I see Samuel Godfrey Brown coming in, said, good evening, sir. Good evening, Samuel. I hope you're doing well. And welcome to the live stream today. So give us a thumbs up on the video, share the video as well. Let us reach as many students as possible. Lovis Dominic Lai said, hi. Okay, hello. Uche Ijehu, hi. Uche, it's been a long time since I heard from you. I hope you're doing well. I'm doing well. Hello, Uche. Frank Thompson said, good evening, sir. Good evening, Frank. I hope you're doing well. Welcome to the stream. Eugene Senu Mape Adonu said, good evening, NP. Good evening, Eugene. Forgive me if I don't mention your name right, okay? Just forgive me about that. So welcome to the stream, everybody. I see some of you guys joining. Welcome to the stream. Give us a thumbs up on the video when you join the stream, and share the video as well so we can reach as many students as possible. Most importantly, also, if you have any questions, please put it in the chat box, put it in the comment box. I'm going to be reading all of your questions. Whatever it is that you want me to share my thoughts on, put it in the chat box. I want to hear from you, and also answer any questions that you have for me. Atta Kwame said, hi, sir. Hello, Atta Kwame. Ronnie said, good evening, sir. Hope all is well with you. Yeah, Ronnie, I'm doing well, and I hope you are also doing well. Eugene Ade Kusi said, good evening, sir. Good evening, Eugene Kusi. Azakro Steven. Let's stay with Steven. Hi, Steven. Nefisa to Ankara said, good evening. Hi, Nefisa to good evening. Witness Lebo, okay, just Witness said, good evening, sir. Hi, Witness. Welcome to the live stream. Forgive me if I don't mention your name right, okay? Just forgive me. Some of you, I'm going to be butchering your name and saying it the way you don't like it. But Leonard said, hi, bro. Keep up with the good work you are doing. Thank you very much, Leonard, for joining the stream. So put in the chat box for me any questions you have for me, whatever it is that you would want me to share my thoughts on. Kofi Prof said, good evening, Nhyira. Hope you are okay. We'll engage you much, God willing, next year. Okay, Kofi, we are always here, and we'll be here for you next year as, God willing, you start with your journey on that case. Right, so let's get into our discussions for the day real quick, and then go ahead with what it is that we need to do in order for us to prepare well for our examination, and that is very, very important. So, like I mentioned, there are 5 accounting standards we're going to be looking at today, questions relating to these accounting standards. And like I said, the question has also been shared already on my Instagram page at Nhyira Premium, so you can go there and you get access to the questions and you'll be able to follow in that order. But I'm going to also be sharing my screen with you here so that you will be able to also follow through as we discuss it together. And like you can see, I've already started sharing my screen in there for us to go through it. Right, so 5 accounting standards today, and these accounting standards are very critical. They are very fundamental when it comes to your examination and how you prepare for your exams, whether you're writing corporate reporting or writing strategic business reporting or writing financial reporting or writing F7. These standards are going to play a critical role as you prepare for your examination. So Emmanuel Amwako said, "Hello Nhyira, I love your teaching. It helps a lot." All right, Emmanuel, thank you very much. Mavis from Facebook said, "Hello sir, hi Mavis, I hope you're doing well. Welcome to the live stream. Give us a thumbs up, share the video, and most importantly, comment in the chat box any questions you have for me." So let's go straight up to our question. Let's go to the, okay, each question actually has its own requirement. So I thought it was just like yesterday, so I wanted to go to the bottom and find out what the requirement was. But we just go straight up into it. So the first question A is on IFRS 5, non-current asset held for sale and discontinued operation. Non-current asset held for sale and discontinued operation. So let's look at how we go through this particular one and see what we need to look at in relation to that. So requirement said calculate the carrying amount of assets that can be classified as held for sale. That can be classified as held for sale, assuming, very, very important, assuming that relevant criteria are met where appropriate after applying the measurement rules of IFRS 5. Where appropriate after applying the measurement rules of IFRS 5. So this is on non-current asset held for sale and discontinued operation. Pius Ajiman, I see you. You are welcome to the stream. Emmanuel Amakon with a thumbs up in there. Vincent A said, "Good evening, sir." Good evening, Vincent. And you will come to the stream. Give us a thumbs up on the video when you join. That way we get more engagement. And YouTube and Facebook will be able to push it so we can reach as many students as possible. So let's come back to our discussions here. Now, before we go into the question, just a brief understanding on IFRS 5, that is the non-current asset held for sale and discontinued operation. Now, with this standard, we can look at 2 things here. Non-current assets held for sale, like the name suggests, and discontinued operation. So this is where an entity has been using an asset for a number of period, but then for some reason, they would not want to use the asset again for the purpose for which they intended it to be used. Maybe because of the fact that they are reorganizing the company, or they are not able to use the asset again due to whatever reason that it is. So now the asset that is being accounted for as a held for as a non-current asset in accordance with IAS 16, or as an investment property in accordance with IAS 40, will now be accounted for as a held for sale. But then before we can recognize an asset as a held for sale, we have to meet the recognition requirement, which is the sale recognition requirement, sale. So that is the NIMOC for the recognition requirement for held for sale, or of held for sale. Now the discontinued operation aspect also, it's just about where, again, an entity would want to reorganize its operation. So probably there is a division that is not making money, or there is a subsidiary that is not making money, and they want to close that division down or close that subsidiary down. So now they cannot account for it as a going concern, but they are going to be preparing whatever segment report or separate financial statements on a breakup basis for those entities or for those divisions. So those divisions, even though they were previously being carried at their carrying amounts, now they are going to be carried and IFRS 15 held for sale. But in either case, whether we are dealing with held for sale or we are dealing with a discontinued operation, the recognition criteria remains the same. That is the sale recognition criteria. The S here simply means that sell. So management must have an intention to sell the assets. That is the first recognition criteria. So management must decide, they must have an intention that, hey, we want to sell this asset or we want to discontinue this operation. We cannot continue producing this product any longer. We cannot continue to run this division any longer. So we want to sell the division. We want to sell the asset, or we don't want to use the asset any longer. Please note, where a non-current asset is put into a working condition book, then it cannot be recognized as a held for sale, because a working condition book is where they say that, oh, temporarily we're not going to be using the asset. However, we don't have an intention of selling the asset. We are holding on the asset so that in the future, if the economy gets better, then we can continue to use the asset. So in that case, the asset will still be there and we will still continue to charge depreciation on the asset. Why? Because it is in a working condition book. But if the company is not saying that, oh, we are resting this asset because of the economy and we are not going to come back and use it again, we just want to sell it, then the first recognition criteria has been met. So the S there means sell. Then A means availability. Availability. Now, the fact that an entity wants to sell something does not mean the thing is available for sale. So the asset has to be put in a saleable condition. The division has to be put in a saleable condition. So for instance, if I tell you that, or if an entity says they are going to sell a plant, but they are still using the plant in the production of goods and services, that means it is not available for sale. So A means that it has to be available for sale. That is the second recognition criteria. But not only that, the fact that the asset is available for sale does not mean that we would actually want to sell it. So sometimes management has decided to sell the thing. They are no longer using it, so it is available for sale, but they are not advertising. They are not looking for buyers. So L here means we are locating a buyer or looking for a buyer. This is through advertisement. So the company must have advertised that, hey, we are selling this asset or we are selling this particular subsidiary. If they have advertised or they are looking for buyers or they have even located a buyer and they are just negotiating how much they need to dispose of it, then the L criteria has also been met. So number one, management must decide to sell the assets. Number two, the asset should be available for sale, put in a saleable condition. The entity cannot be using the asset and say that, hey, we want to sell the asset. That is not possible. Then L, they must locate a buyer or be looking for a buyer through advertisement or publications on their website or something like that, or on their social media platforms that, hey, we're selling this asset. That is the L. Then the E aspect says that the asset, the sales is expected to be completed in less than 12 months. So that is the E aspect. Sales is expected to be completed in less than 12 months. So that is what we mean by the sale recognition criteria. The sale recognition criteria. So management has an intention to sell the asset. Asset is available for sale. They are looking for a buyer or they've already located a buyer, and they expect that the sale will be done in less than 12 months. In less than 12 months, just like that, in less than 12 months. That is what we mean by the sale recognition criteria. So if this criteria is met, the standard says that because now the asset or the division or the operation has now become a held for sale, the standard says that it should be carried at the lower of cost or net realizable value as per IAS 2 inventories. Okay, so we're going to be carrying whatever asset, whatever division that we are going, if it meets the recognition criteria, we will carry it at the lower of cost or the net realizable value. In other words, we're going to be comparing the carrying amount at the date of the decision with the recoverable amount. And if the carrying amount is more than the recoverable amount, we carry it at the recoverable amount. If the recoverable amount is more than the carrying amount, we carry it at the carrying amount. Then on subsequent measurements, the same thing we'll be looking at. If there is any impairment in the assets, or yes, in the assets, after the initial recognition, that impairment will also be recognized in the P&L account. Why? Because now it is seen as an inventory and has to always be carried at the lower of cost or net realizable value. So that is what you need to understand about IFRS 5, non-current asset held for sale and discontinued operation. Comment in the chat box, comment in the comment section, let me know if you understand and if there is anything that you want me to clarify real quick on it before we go into the question, because I needed to give you this background understanding of the standards before we get into the question, so that when we get into the question, you are just recalling the principles, the rules, to help you to be able to understand what exactly we're looking at. Festus from Uganda just joined. Thanks, my professor. All right, Festus, you are welcome to the stream. So let's go into the discussion real quick. Now let's look at the question we have here. Let me know if you have any questions, put it in the chat box for me. So let's go. Acca K Limited has the following assets, which it would like to classify under IFRS 5, non-current assets held for sale and discontinued operations today. So you've got to understand what is going on here. The company wants to classify the following assets as per IFRS 5, non-current asset held for sale and discontinued operation today. So they want to make that decision of classification today. I mean, right now for the organization. So we see in the table, there are 4 assets in there. We see that the examiner has given us the carrying amount of the asset as of today, the open market value today, that is the selling price if you want to, and then the estimated cost to sell. Now, when we talk about this, somebody will ask, why is the examiner giving us this? Because remember I told you that non-current asset held for sale or discontinued operation must be carried at lower of cost or net realizable value. So the examiner has given us the open market price, which is the selling price today, and has given us the estimated cost to sell. Why? Because we need to calculate what? The net realizable value for the assets if they fall into the category of if they fall into the category to be recognized as a held for sale and discontinued operation. That is very, very important. So the requirement here is calculate the carrying amount of assets that can be classified. Now, you've got to be careful here. I'm going to drop a bomb here. So you're going to be careful to get the meaning of whatever is going on very well. Calculate the carrying amount of assets that can be classified as held for sale, assuming the relevant criteria are met where appropriate. So the examiner is saying that we should find out how we can calculate the carrying amount of the assets if the recognition criteria has been met and it is appropriate. So let's look at what is going on here. There are 4 assets in the table there. We see investment properties at fair value through profit or loss. We see land used as company car park held under the revaluation model. We see trade receivables, and we see plants held under the cost module. So the question we ask ourselves is, these 4 properties or assets here, do they all qualify to be accounted for in accordance with IFRS 15, non-current asset held for sale and discontinued operation, or not? That is the question we need to ask ourselves in relation to that. Now, I see some comments coming in. Let me look at them real quick. Mavis Adam from Facebook said the explanation is very clear. All right. Nicholas said, good evening, sir. Please, the introduction again. Probably you would have to rewatch the playback because I said a lot in the introduction, though. Uche said, what are the differences between financial reporting and corporate reporting as a subject as regards group accounts? Oh, okay. With financial reporting, you are doing simple group accounts, meaning parent, subsidiary, and associate. But with corporate reporting, with group accounts, you may be doing a complex group. So you are doing parent, subsidiary, sub-subsidiary, associates, and even foreign subsidiary. So that is the difference about group accounts. So with the corporate financial reporting, it's a simple group, parent, sub, and associate. But with corporate reporting, you are doing parent, sub, another subsidiary, associate, and then sometimes foreign subsidiary. Meaning, we own a company that also owns another company, and so it becomes a complex group structure there. That guy said, hi, hello. Samuel Godfred said, please, sir. Samuel, did you say something that I missed? Okay, I guess you didn't say anything. Josie Chamado said, can an entity change their mind about classifying as non-current assets held for sale if they wish to continue to use or operate the assets? If so, what effect would this be in its financial statements? Okay, so if, for instance, an entity is accounting for the assets, or they have decided that they will sell the assets, so meaning that now they will be carrying it as a held for sale, then later on they change their mind to use it in the operation, we just reverse the account in that case. What is going to happen is that as at the dates that they are reversing again from a held for sale to using it under IAS 16, we'll just calculate the fair value of the asset, or look at the fair value of the asset, and then we'll carry it at that value on subsequent measurements. That is all in that case. So it doesn't affect them that much in that. AFTC TV said, please, is this class for FR or CR? It is both for financial reporting and corporate reporting. Very, very important. This is accounting standard, and that cuts across from financial reporting and corporate reporting. Someone said, please, sir, can you explain the carrying at a lowest cost? Okay, so what we said is that on subsequent measurements, the non-current asset held for sale should be carried at lower of cost or net realizable value. It means that you're going to compare the cost or the carrying amount of the asset with the net realizable value of the asset. The one that is lower will be the amount at which we're going to be carrying it. Stay with me as we solve the question, and this will be clear to you in a moment. Abiodan said, hi, hello. Good evening, Abiodan. I hope you're doing well. Right, so let's go back to our questions and then let's find out what it is that we can do there. So let's look at the first thing. We see investment property. Now, stay with me very carefully here on this one, investment property. We said investment properties at fair value through profit or loss. This is an investment property at fair value through profit or loss. Now, look at the question. It's like the examiner is setting a trap for us, and he wants us to fall into the trap and do something. It says, calculate the carrying amount of assets that can be classified, as held for sale. Into brackets, assuming the relevant criteria are met where appropriate. Now, if a company has an asset, an investment property, and they are already carrying it at fair value through profit or loss, then it cannot be classified as a held for sale. Okay? It cannot be classified as a held for sale. So that particular investment property there cannot be classified as a held for sale. So that is going to be out of the game. That's out. Because it's an investment property and the entity is already carrying it at fair value through P&L. So that investment property cannot be classified as a held for sale because they are already carrying it at a fair value. Does it make sense? So that one will be out of our workings. That will not be included in our workings in relation to that. Ronnie said, can the question be posted on the WhatsApp chat room? Okay, yes, it will be posted on the WhatsApp chat so that you'll be able to get access to it. So the property number 1, it's out. That is not going to be included in our workings because it's an investment property. It has to be accounted for in accordance with IAS 40 investment property. So that is going to be out of the system. Remember the requirement said, calculate the carrying amount of assets that can be classified. That can be classified. The first asset cannot be classified as a held for sale or discontinued operation. Number 2, land used as company car park. Land used as company car park, held under the revaluation model. Land used as company car park, held under the revaluation model. Now, if the company is using the land as a car park and they are accounting for it under the revaluation model, that land can be sold anytime, anywhere. Because probably they bought the land and they are using it as a revaluation model. So once they have a better price, they will be able to sell that property. So with this land, it can be accounted for or it can be classified as a held for sale. It can be classified as a held for sale. Why? Because it is a land and it's being used as a company car park and it is held under what? The revaluation model. Revaluation model. So this one can be accounted for as a held for sale and discontinued operation. So in that case, what do? We see the carrying amount already given to us as what? 49 million Ghana cedis. 49 million Ghana cedis. So if it is a 49 million Ghana cedis, what do? We see the fair value here as 50.5. Then we see the estimated value at 1 million. So we subtract that one out, and then we need to ask ourselves, the difference will give us the net realizable value. So 50.5 minus 1 will give us 49.5. Okay? So we compare 49.5 with the 49. The lower becomes the value at which the asset will be carried at. How we are getting it will be the value at which the asset will be carried at. So what does that mean? It means that that 49 becomes the value at which we're going to be carrying this particular investment property. Sorry, this particular asset held for sale. Sorry, this particular asset held for sale. So the net realizable value is 49. The carrying amount, sorry, is 49.5. The carrying amount is 49. The lower of the two is 49. So the land used as the company's car park will be carried at 49. Now I see some questions coming in. Let me look at them real quick. Emmanuel said, what of the investment property is carried at the cost model? We are not even told what they are using. It's being carried at fair value through profit or loss. So if they are being carried at fair value through profit or loss, definitely it means that they are carrying it as an investment property in accordance with IAS 40. If they were using it or they are carrying it at the cost model also, it means it's an investment property, and an investment property should be carried in accordance with IAS 40. So it will still not be classified under this scenario as a held for sale. Bello said, my name is Abubakar Bello from Kano, Nigeria. Please, can you also treat IAS 20 government grants? Thank you. Yes, stay connected. There is a standard on government grants we'll be looking at. Abiodan said, please take that again. Land use as car park. Okay. So that was what we were on briefly. Land use as company car park held under the revaluation module. So the land is being used as a company's car park held under the revaluation module. So it's a land that is there. And remember the requirement of the question, it says calculate the current amount of assets that can be classified as held for sale, assuming the relevant criteria are met where appropriate. So the land used as the company's car park and being held under the fair value module suggests to us that, okay, if it is being held under the fair value model and it's a land that is the company is currently using as a car park, possibly they have an intention of what? Selling it. That is why they are carrying at a fair value. So that if the money goes out, then they can dispose it off. Then in that case, the open market price is for 50.5. The estimated cost to sell is 1. So when we subtract that, we get 49.5, and that is the net realizable value. So when we compare the net realizable value against the current amount in the books of the company, which is 49, the lower of the two is the 49. So we're going to be carrying this at 49. Okay, we're going to be carrying this at 49. So that is the treatment of that. Abiodan, you said I should take that again. So let me know if that is clearer for you. Then the third item. Now, stay with me very carefully here. Let's look at the third item. The third item is trade receivables. Can you imagine? How can you carry trade receivables as a held for sale? Trade receivables is how much people owe you. And how can that become a held for sale? So the trade receivables is also going to be out, because trade receivable does not fall within the scope of IFRS 5. It is outside the scope of IFRS 5. So the trade receivables also cannot be accounted for as a held for sale. The investment property is outside the scope of IFRS 5, cannot be accounted for. The trade receivables also cannot be accounted for. Then the last item we see there is plant. Plant held under the cost module. Plant held under the cost module. Now, if it is plants that they are having, yes, it can be classified as a held for sale, because the company can decide that, hey, we are producing the products, or we are not having a good economy, or our production capacity has reduced, so let's sell off the plant, or people are not buying the product again, so let's close down the division, let's sell off the plant. So the plant can be classified as a held for sale. The plant can be classified as a held for sale. But look at the sweet spots here. You realize that with the plant, how do we get a net realizable value? You will see that we have the open market value to be $10 million. Then we have the selling cost to be 0.5 million Ghana cedis. Forgive me about the currency. Okay, Ghana cedis. So when we subtract it, we're going to get what? That would be 9.5, I guess. Yes, 9.5. So this becomes the net realizable what? Value, 9.5. But look at the carrying amount. The carrying amount is 14 million Ghana cedis. So the lower of the two, it means the plant will be carried at what? 9.5. That is the lower of the amount. That is it. So in this question for 4 marks, the land will be carried at 49, and then the plant will be carried at what? 9.5 in relation to that. Does it make sense? Let me know in the chat box if you understand it very well. And then let me go and then let's present our solution up, down here. So the A. We could present our solution in such a way that we'll be able to carry the amount. So we can have It's Ghana cedis, not dollars. I'm just trying to stay with the currency. We have Ghana cedis million, something like that. So the first item was the investment property that will be out. So the investment property will be out. Nothing will become of it. So we put dash there. Then the land, we did a workings for that. In the slide there, let's go up and pick it up. So we said that 50.5 minus 1 will be 49.5. When we compare 49.5 with the 49 is lower than 49.5. So the land will be carried at 49.5. Sorry, 49. So we're going to have 49 here. Then the trade receivables. What did we say? We said trade receivables is outside the scope of IFRS 5. So that one also will not be accounted for. Then the last one was the plant. And we said with the plant also, we did a workings for it. Let's go back and pick it up. So we said the selling price is 10 million. The selling cost is 0.5. So that becomes 9.5. As against the carrying amount of 14, we're going to be carrying it at the 9.5. So we pick that up. 9.5. Right? So we add all of them up there. So let's see what we get. That will be 58.5 million Ghana cedis. So that is the answer to the A aspect of the question. Very simple, straight to the point. And remember, this is a 4 marks question. It's a 4 mark question as per the requirement. So that is the answer to our question, the A aspect in that case. So comment in the chat box if you have any questions for me on that. I see some comments coming in. Abiodan said, okay, thanks, sir, you're welcome. Ariyu said, good evening. I hope I have not missed much. Oh, probably you've not missed that much. Mavis Edem said, very understandable. All right, Mavis. So that is it about the A aspect of the question, and that is under IFRS 5, non-current asset held for sale and discontinued operation. My objective in this question is for you to be able to know how to determine the carrying amount of a non-current asset held for sale and discontinued operation. Always know that you compare the net realizable value with the carrying amount, and the lower of the two becomes the amount at which you're going to be carrying the asset in your books. Very, very important. Very, very important. So let's go to the B aspect of the question, and that is on our good old standard, that is IAS 2, inventories. Inventories. Now, when it comes to accounting for inventories, you know that I've already mentioned this indirectly in the A aspect of the question. Inventory should be carried at what? Lower of cost or net realizable value. Okay? Inventory should be carried out lower of cost or net realizable and net realizable value. So we compare what is the cost of the inventory as against the net realizable value. The lower of the two will be the value at which an inventory will be carried. All right? So we're going to look at the cost of the inventory. We're going to look at net realizable. Net realizable value means if we sell the inventory, how much are we going to get? If we sell the inventory, how much are we going to get? And to get your net realizable value, like you've seen already, is the selling price minus the cost to sell, right? Selling price minus the cost to sell. Very simple in that case. So let's go straight up to the question, and that is a 3-mark question. Let's see how we're going to work on that 3 marks question. Now, I see some of you joining the stream as well. Welcome to the stream, and consider to give us a thumbs up on the video. That way we get more engagement. And also share the video, especially for those of you who are watching on Facebook. Share the video. Let us reach a couple of students around and see what we can do to assist others to prepare well for their exams, as we are all in this together. So share the video. Let's reach as many students as possible. And most importantly, give us a thumbs up on the video as well. So let's look at those questions. SINAM Limited. SINAM Limited. Mawe Sinam. So SINAM Limited has the following products in inventory as at the end of 2016. Now remember, periods are very important. So we have the inventory here at the end of 2016. Very important. So we see two products here, Ahomka and then Adonko. But you got to be careful about what is going on here. We are told that the Ahomka is completed, but the Adonko is part complete. Okay, so more or less like the Adonko is a work in progress product. Okay, it's a work in progress. It's not completed, but it's a work in progress. So Ahomka is a completed product, but the Adonko is a work in progress product. So let's see. The units available, 5,400 for Ahomka, and then 2,800 for Adonko. Okay. Cost per unit currently stands at $22 and then $26. Oh, sorry. 22 Ghana cedis and 26 Ghana cedis. Forgive me if I like mess around with the currency. It's not good though, but just forgive me about that. So if we want to determine the cost right now, or the current amount of the inventory, total cost of the inventory, we're just going to multiply up and then get our answers. Can we do that? Let's see if we can do that. But before then, there is a note in it. Each product normally sells at 34 Ghana cedis per unit. Easy. So the examiner has given us the selling price per unit as 34 Ghana cedis. Look at the build-up. Due to the difficult trading conditions, SINAM Limited intends to offer a discount of 15% per unit. 15% per unit. Easy. What it means that even though the product normally sells as 34 Ghana cedis per unit, now it can only sell at 85% of the 34. Why? Because the entity is giving or will be giving a discount of what? 15% per unit. So right now, our selling price per unit will be 85% of the 34 Ghana cedis per unit. Does it make sense? So new selling price will now be 85% of 34. Let's see what we got on that. 0.85 by 34. Boom. I'm getting 28.9. So that is our new selling price, 28.9. That's our new selling price. $28.9. So that is the new selling price per unit. That's what we're going to use. So we're not going to use the 34 because of the discounts build up in the question that the company is going to offer. So now the selling price we're going to use is 28.9. But look at it. And expects to incur 4 Ghana cedis per unit in selling cost. Okay. So the cost to sell is 4 Ghana cedis. So the company expects to incur a cost of 4 Ghana cedis to sell the product. That means that if we want the net realizable value per unit, stay with me carefully. If we want the net realizable value per unit, it will be the 28.9 minus the 4. Does it make sense? 28.9 minus the 4. So if I want right now the net realizable value per unit, it will be the 28.9 minus 4. And that's going to be 25.9. Does it make sense? That is, if I want the net realizable value right now, no, that would be 24.9 rather, 24.9. If I want the net realizable value per unit, that is what it's standing at now. I hope you are getting the build-ups very well. Then it says 10 Ghana cedis per unit is expected to be incurred to complete each unit of Adonko. So when it comes to Adonko, remember in the question we are told it is part complete. So it's a work in progress. But you know, you cannot sell partly complete goods unless otherwise. That is what we do as a company. But then to get a finished product and ultimately sell the finished product, we need to spend 10 Ghana cedis per unit to complete it. Okay. What it then means is that when it comes to Ahomka, we can conclude that the net realizable value per unit for the Ahomka is 24.9. But then when it comes to the Adonko, the net realizable value for Adonko will be different. And that is going to be, let's build it up. So the net realizable value for Adonko is going to be our 24.9, okay, which is what everybody would have gone for, minus the cost of production or the cost to complete 10. So that right now, the net realizable value per unit for Adonko is going to be 14.9 Ghana cedis. Does it make sense? We are done. Literally, we are done right now. So that is how we go about it in relation to that. But we are not done yet, right? But we have just done the working. So when it comes to Ahomka, our net realizable value per unit is 24.9. But when it comes to Adonko, our net realizable value per unit is what? 14.9. 14.9. 14.9. So now that we've calculated our net realizable value per unit and we know our cost per unit, let's put it down in a tabular form and then let's find out how we can actually present our way in that case. So let's go to our solution slide on that. So let's see. So that is the B aspect of the question. And professional presentation is also important. So I'm trying to think the way I can present it, then we get a carrying amount. So we're going to bring the inventory here, the inventory type here. We're going to bring the cost here. We're going to bring the net realizable value. Then we're going to bring the carrying amount. CA here is carrying amount, okay? And there are, because professional presentation is very important. So the cost will be here, the net realizable values second, and then the carrying amount, which is the amount at which we're going to actually be carrying it. So we are working in Ghana cedis. Let's try to put that currency up. I don't like writing it at all because it takes a long time. So two inventory types here. We have the Ahomka. Is it Ahomka? And then Adonko. So two inventory types here. And then we can bring the number of units in the middle slide here. Number of units. Let's go up and then pick that up real quick. It is 5,400 for Ahomka and then 2,800 for Adonko. 5,400 to 800. So 5,400 to 800. So these are the units respectively. Now, we've already done the workings for our cost per unit. Oh, no, we don't have to do workings for cost per unit. The cost per unit is already there up in that case. So we go build that up in there. So 5,400 times 22. That's going to be 118,800 So we do the multiplication. 118,800 118,800. Then for Adonko, it's going to be 2,800 times. Oh, they didn't get the figure at once. That's 26. So 26. That'll be 72,800. 72,800. So that is the current cost now of these inventories respectively. Then we go to the net realizable values respectively as we computed above there. 24.9 for Ahomka. So we're going to pick 24.9 times 5,400. And that is 134,460, right? Then let's go for Adonko. We had Adonko to be 14.9 from our workings here, right? 14.9. That is after the cost to complete. So 14.9 by 2,800. That's 41,720. 41,720. All right. So now we have the cost, we have the net realizable value. Remember how we carry it. We're going to be carrying it at lower of cost or net realizable value. So we will compare the two figures we have there. So if you look at the Ahomka, what is going on there? You see that the cost is 118,800, but the net realizable value is 134,460. Now, you realize that the net realizable value is greater than the cost. So we will carry it at the cost 118,800. 118,800. So we'll carry it at the cost as the carrying amount. I hope you are getting the idea. Then when it comes to Adonko, the net realizable value is 41,720, but then the cost is 72,800. So we're going to be carrying it at what? The net realizable value, which is 41,720. Meaning that, stay with me carefully on this bomb that I'm coming to give to you. Meaning that the Adonko inventory has actually suffered some impairments. I get in it, has suffered some level of impairment in relation to that. So we add the two up, and that will be the total carrying amount of our inventory. 41,720 plus 118,800. That's 160,150. 160,520 rather. 160,520. So that is the answer to this question on the inventory. Any questions? Everybody good? Comment in the chat box. Let me know if you understand. So you see how the computation is done? Now remember, this can be a footnote to a final account question. Okay, so maybe you are in FR and you are doing statement of profit or loss and other comprehensive income, statement of financial position, and the statement of changes in equity. You're dealing with all that, and this is a footnote. So that is just a footnote, and you are going to deal with a footnote, and this is how you go about it in that case. Or it can be a standard question, like you see in this question here. It's part of the standards questions that the examiner is bringing on, and that can be for corporate reporting, and that would also be, or that could also be for financial reporting. And so that is very critical in relation to that. Olims Gunda said, I lecture are so helpful. Have you done any series on advanced audits? And if so, are they on YouTube, on your YouTube channel? Yes, you go on the YouTube channel, on the playlist, you will see advanced audits there. Definitely there are contents there on advanced audits that you can see in relation to that. Rose said, thank you, sir. You are welcome, Rose. Samuel Godfred said, thank you, sir. Well understood. All right, that is fine. Uche Ijehu said, very clear. Okay, that is good. That is good. I love it. I love it that we are all getting it clearly. So that is IAS to inventories. IAS to inventories. Very simple, sweet, straight to the point. So let's move on to the third one. And that is under IAS 16, I guess. Ayariga Limited, IAS 16. That is under Ayariga Limited. And that is for 5 marks. No, it doesn't look like IAS 16. It's actually IAS 36, Impairment of Assets. Okay? So let's read the requirements of the question then. I want to make sure I have it on the screen once, like that. Yep. So let's look at the requirements there. So the requirement is, in accordance with IAS 36, Impairment of Assets. Now remember, in some circumstances, the examiner can be generous and tell you what kind of standard is in place. Mostly, if in financial reporting, he will do that. But in corporate reporting, he might not tell you the specific name of the standard. So there, you need to be smart enough to be able to know which standard is actually in place here, and to be able to apply the principle based on the reading you got or the understanding you got from the question. So let's see. In accordance with IAS 36, Impairment of Assets, recommend with workings, in brackets, very important, recommend with workings how the above transaction should be accounted for as at 1st January 2017. Remember, I keep on telling you, anytime you're dealing with accounting standards, the period is very important. The year is very important. So you don't just get up and start working, but you got to understand what are the workings available in relation to that. That is very, very important. So if we look at it in that case, what do we have there? So the date is very important, 1st June 2017. That is where we are supposed to account for. I see a comment coming in from Josie Chamada. She said, I thought the 10 cents was added to the cost of Adonko, 26 plus this, so it becomes, it's not 10 cents, it's 10 Ghana cedis. So that is a cost to completion. That will be factored when determining the net realizable value. Okay, it will be factored when determining the net realizable value and not determining the cost. The cost has already been given for partly completion, but that will be because the reason why we don't add it to the original cost given is that the inventory cannot be sold without completing it. So that would rather be factored into it when dealing with the issue in relation to the net realizable value instead, and not dealing with the cost of the inventory. So, Josie Chamado, that is a clarity on that. Fiona Joy said, hello, is there something for revaluation for assets and property, plant and equipment schedule? We are going through the question, so possibly, definitely there will be something about that. So you stay connected. Probably that is your pain point you want to deal with, right? So let's go back to the question. Ayariga Limited acquired. Now, I see some of you guys joining the stream as well. Welcome to the stream. And consider to give us a thumbs up on the video, right? Give us a thumbs up on the video. That way we get more engagement on the video. And also comment in the chat box any questions you have for me. If it is possible, which I know, share the video as well so we can reach as many students as possible watching the stream or watching the playback of the stream. So let's go. Ayariga Limited acquired its head office on 1st January 2007. So be careful here. Remember the year ended or whatever period it is, the examiner said is 1st January 2017. But then they bought the asset on 1st January 27 at a cost of 10 million Ghana cedis, excluding land. So there is an office, head office that they bought in 2007, and the value is 10 million Ghana cedis, excluding the land. So it means it was the building that they bought. The company's depreciation policy is to depreciate property over 50 years on a straight line basis. The estimated residual value is ZOPO, or zero. On 31st December 2011, okay, take it easy. So let's try to find out what is going on so far in the question. So the asset was bought on 1st January 2007. Then on 31st December 2011, the company is revaluing the assets. So Fiona, in case you are not gone, this is what you're asking about, and it is coming in here. So the company revalued the assets to 60 million Ghana cedis. Okay. So from 1st January 2007 to the 1st December 2011, we need to calculate the carrying amount of the assets. So the question we ask ourselves is, what is the carrying amount of the assets? Right? So how long has the asset been used? So we have 2007, 2008, 2009, 2010, 2011. That is 5 years. So 7, 8, 9, 10, 11. So the asset has been used for 5 years. So we're going to calculate the depreciation, accumulated depreciation for the asset for 5 years, and take it from the cost, and then we will be able to get a carrying amount of the asset as at that date. Why is that important? So that we can know if there is any revaluation loss or revaluation gain and how it will be accounted for. But look at the trickle. In accordance with IAS 16, property, plant, and equipment, the company has decided not to transfer. Listen carefully. Now, under IAS 16, when companies revalue assets, the depreciation is going to be carried on the revalued amount. Now, when the asset is revalued and it is greater than the recoverable amount or the carrying amount, it results into a revaluation surplus. Now, when the depreciation is now calculated on the revalued amount, what is going to happen here is that more depreciation will be charged than it should have charged, which means the profit available to the shareholders will be reduced. Now, the standard allows that to compensate shareholders for the reduction in the profit as a result of the revaluation of the asset, there should be an annual transfer from the revaluation surplus account to the retained earnings. And that annual transfer will be the revaluation surplus divided by the remaining economic useful life of the asset. And this annual transfer is just the same as the excess depreciation that we are having. And that will be transferred from the revaluation surplus to the retained earnings so that we will be able to now compensate the shareholders and get the returns they are supposed to have had, if not for the revaluation of the assets. But in this question, we are told that the company has decided not to transfer annual amounts out of revaluation reserves as assets are used. So they don't want to do the annual transfer. They don't want to make the transfer from the revaluation surplus account to the retained earnings. So we will also not do it. So since they are not going to do it, since they are not prepared to do it, we also not going to do it. So you got to be careful there. So whatever revaluation surplus you're going to have, it will just be in the revaluation surplus account. It will be taken to the statement of other comprehensive income, OCI, and taken to the other comprehensive income, and that is all. No annual transfer as of 31st January 2011. But look at what is going on. In January 2017, storm damage occurred, and the recoverable amount of the head office property, excluding land, was estimated to be 5.8 million. So you got to ask yourself another question here. Remember, the useful life of the asset is 50 years. You've used it so far for 5 years up until 31st December 2011. Then from 31st December 2011 to 1st January 2017, that is how many years? So that is 2012, 2013, 2014, 2015, and 2016. That is another 5 years. So right now, after that revaluation to 16 million, the remaining life is now 45 years. So we're going to do 16 over 45 times 5 to get a carrying amount. Then now you see that there is a downward revaluation here. Where there is a downward revaluation, the standard says that you don't just take that revaluation loss to the P&L account. No, the downward revaluation or revaluation loss will be written off against previously recognized revaluation gain, just like the question we discussed yesterday. How we are getting the treatment. So now we have the pieces together. Let's go to our working dashboard or slide, and then let's put all the pieces together. So number one, what are we seeing here? We are seeing that the asset has a useful life of 50 years at the start, and it has been used up until 31st December 2011. And so let's calculate the carrying amount as at that date. The cost of the asset is $10 million or 10 million Ghana cedis. So let's calculate the carrying amount. Then we will compare it with the revalued amount of 16 million, and then let's see what we're going to have in that case. So let's scroll down to our working slide. Now that is note C, or question C if we want to. So let's put in Ghana cedis. Now our figures are given in million. We can work in thousands to bring some level of uniformity. So we can work in thousands here. So let's bring the cost of the assets. That will be 10,000. Remember, we are told that the recoverable amount is nil. I hope you saw that. Let's go back to the question and pick that up. The estimated residual value is 0. Now, if the estimated residual value was having an amount, we would have deducted it. So let's bring the accumulated depreciation. So accumulated depreciation for the 5 years ended 31st December 2011. Now that will be 5 years period. So that's going to be 10,000 divided by 50 years times 5. 10,000 divided by 50 years times 5. So 10,000 divided by 50 times 5. That's going to be 1,000. Am I right on that? That'll be 1,000. Okay. So that is our accumulated depreciation. We take it out. Then, so the carrying amount as at that date, 31st December 2011, will be 9,000. Will be 9,000. Okay. So now that we have the carried amount, then the following day, which is 1st January 2000, let's go back to the question so on that same day, 31st December, it was revalued at 16,000 or 16 million. So let's bring that up on that same date. So fair value on that same date was 16,000. So what do we see here? We see a revaluation surplus here that I was talking to you about. So revaluation surplus. So that is going to be how much? 16,900, 7,000. So that's our revaluation surplus. That's our revaluation surplus as at that date. Then let's go back to the question. We are told that the asset was used or has been in use, and in January 2017. So the asset from 2012 to 2016. So 12, 13, 14, 15, 16. Because the revaluation occurred on 31st December 2011. So the following period will start from 2012, 2013, 2014, 2015, and 2016, because the revaluation again was done in January 2017. So another 5 years there. So we go through it. So let's calculate the accumulated depreciation again. As at 1st June, if you want, 2017. And that will be 5 years, okay? So let's put that in the bracket, 5 years. So now remember, now your recoverable amount is 16,000. You got to be careful there. The remaining useful life is 45 years. So times 5 again. I hope you are getting it. 45 years. Why is it 45? Because the whole remaining useful life was 50. Okay, it was 50. But you've used 5 already. So as at the date of the revaluation, they did not change the useful life. So we will stay with the 50 years. So we've done 5 already, remaining 45. So now the 16,000 will be depreciated over 45 years. And we've used it so far for another 5 years. So 16,000 divided by 45 times 5. And I'm getting something like 1,177.7 bowl. So 1,778, maybe approximately 1,7, like this. So that will be taken out, so that we get a carrying value as at 1st June 2017. So 16,000 minus 1,778, that will be 14,222. 14,222. So this is the carrying value at this date, 1st January 2017. But it was on this 1st January 2017 that we were told that another revaluation was done, and this time around the asset value is what? 5.8 million. 5.8 million. So now we bring the fair value up. So the fair value on that same date, 5,800. So you check it out and you realize that the balancing figure here is going to be a revaluation loss. Okay, so let's see what we get. 14,222 minus 5,800. That'll be 8,422. So that is our revaluation surplus. But remember, the requirement of the question is very important. You need to understand what is going on in the requirements before you jump ahead and say you are done. It says, in accordance with IAS 36, Impairment of Assets, recommend with workings how the above transaction should be accounted for as at 31st January 2017. So, as at 31st January 2017, we are getting an impairment or a revaluation loss of 8,422. But remember, this asset already has a surplus of 7,000 somewhere. Okay, so we're going to bring that up. So revaluation surplus brought forward. Remember, there hasn't been any transfer of it. So there's a revaluation surplus of 7,000. We're going to bring that up like this. Then the revaluation loss we had, currently now it's 8,422, so that the balancing figure will be taken to the P&L account. Okay, if you want, we could call it impairment loss. And that will be 1,422. I hope you are getting the treatment. So this 7,200, just like what we did yesterday, okay? If you were here yesterday, just like what we did yesterday. So this 7,200 will go to OCI, other comprehensive income, as a negative figure, okay? Then the 1422 will go to the P&L account. Are you getting it? also as a negative. Now, the asset is going to be carried at the revalued amount, 5,800, and will be depreciated over the remaining useful life of 10 years. The remaining useful life of 40 years, rather. The remaining useful life of 40 years. Does it make sense? That is the answer to the question. Any questions, please? Everybody good? Let me know in the chat box if everybody is good. Let me know in the chat box if everybody is good. So, everybody good? Let's see in the chat box. So that is the answer to this particular question as well. Now, remember the treatment here about the revaluation loss, the subsequent revaluation loss. That is what the examiner wanted to see how you're going to be accounting for that. So remember, the previously revaluation surplus will be now negated in the OCI 7,000. Then the balancing figure goes to the P&L account, and then we get our total revaluation loss in that case. So you don't just take the whole 8,422 into the P&L account and say, hey, that is an impairment on asset or that is revaluation loss. No, because the asset previously had a gain, we're going to be writing it off against that in relation to that. So this is what you need to understand about this question. So let me know any questions real quick. Abdul Samid Al-Hassan said, give me a thumbs up there, okay. Rose said, how did you arrive at 8,422? Okay, we arrive at the 8,422 from here. From here. The carrying value is 14,222, and then the revalued amount is 5,800. So the difference of that is the 8,422. So Rose, you were asking about how we came across the 8,422. That is how we came across that. Does it make sense? Let me know. Mavis Edem said, thank you, Claire. All right. Uche Ijehu said, yes, good. Okay. Ario said, why is 7,000 revaluation surplus going to OCI as negative? It is not revaluation surplus. It is the revaluation surplus brought forward. Okay? It is the revaluation surplus brought forward. Because the asset previously had a revaluation surplus. So it's like we are sharing this 8,422 between the OCI and then the income statement. So what goes to the OCI? What goes to the OCI should be the equivalent of the revaluation surplus previously recognized. Okay? What goes to the OCI will be the revaluation surplus previously recognized. That is why the 7,000 is going into the OCI as a negative, because it's not a surplus. It's the surplus brought forward that we are going to be writing off in the OCI. Does it make sense? Ario, let me know if it does. Ronnie said, excellent, said, excellent, said, blessings. All right. Samuel gives a thumbs up there. Rose said, okay, I got it. Thanks. You're welcome, Rose. All right. So it means that we are on the same page in relation to that. So these are, so far you see what we are doing. So look at what is happening in this requirement, to be specific. In this requirement, the examiner said impairment, IAS 36. But you know that you are really doing IAS 16 here. Because yes, impairment is there. There is some impairment there, but really we're doing IAS 16 in here. So you got to be careful about it in that case. So you see that the accounting standards are coming together. So it is not just the fact that, oh, I have learned IAS 16, then you put it somewhere. I've learned IAS 36, I put it somewhere. No, you've got to find out how you can bring a marriage ceremony between them. Because the standards are not islands on their own. They are always related with each other. And you have to be able to bring that engagement ceremony between them so that they can marry together and stay forever, happily forever after. All right? So that is it about that. Ario said, yes, understood. Thanks, you are welcome. Dachihini, it's been a long time since I heard from you on the live stream. I hope you're doing well and you've been following. Dachihini said, understood. Thanks, sir. You are welcome, Dachihini. Right, so that is what you need to understand about that particular question, the C aspect of that. And remember that our sessions for our Zoom sessions and be able to get access to our online study portal offer is still available at 325 Ghana cedis. So if you are enjoying this content that you are seeing here, imagine getting access to all of the standards, getting access to join our Zoom sessions, getting access to study directly under my mentorship, do assignments, get corrections, hold you on video calls, and assist you on a one-on-one session. So if you are interested in that and you still want to enroll and study directly under my mentorship, get access to our lecture videos, and also be able to join our weekly Zoom sessions and get our ebooks, then you can enroll in our full course at 325 Ghana cedis and get access to that. So you can call 050-114-9296. You see the number scrolling below your screen, and that is how you can reach us out, register, and join our session with that case as well. Right, so Dachimini said, I'm good, said, okay, we thank God. Uche is laughing at my marriage ceremony. That is true, right? So that is it about that. Now, because of time constraints, I'm going to be concluding around here today. And God willing, tomorrow, still with this question, we are left with 2 items to go in for. IAS 20 government grants, very critical treatment here. The footnote they are very critical. We're going to be treating them. And then the last one is borrowing cost, IAS 23, borrowing cost. So I'm going to conclude around here today, and God willing, tomorrow we will come back to this. So tomorrow also we'll be continuing with the accounting standards. After doing these 2, if we still have some time, I'll be taking some Q&A from you guys on accounting standards. So you prepare your questions for me on accounting standards, what you want me to share my thoughts on. And after we solve these 2 questions, we are left with the D and the E. We will take some Q&A sessions on the standards tomorrow as we continue with our discussion. So thank you very much for joining the stream. It's always a pleasure coming your way. As always, my objective is to be able to provide you with the assistance that you need in order for you to prepare well for your examination. In case you're not subscribed to the channel, remember to subscribe to the channel, and most importantly, click the bell notification icon so that way, when I schedule a meeting or do a call, you will be able to join, or when we start a live stream, YouTube will be able to share the link with you so you can join the live stream and be part of the session as well in relation to that. So thank you very much for joining the stream. I'll see you same time tomorrow, 4:30 p.m. or 16:30 GMT, as we continue with our discussion. Remember, tomorrow we will still be continuing with our accounting standard session. So if you're writing corporate reporting, financial reporting, F7 or SBR, still join and be part of the stream. And most importantly, come in with your questions on the accounting standards, and let's see how I can assist you in order for you to prepare well for your examination. So everybody who joined the stream, thank you very much. For all those of you who give us a thumbs up on the video on YouTube as well as on Facebook, thank you very much. For those of you who also took the time to share out the video, thank you very much, and God bless you. We always take a delight in that, because that is how we can grow this community and reach as many students as possible. Please note also this very well, that we will be having our executive revision masterclass for the ICA November 2020 exams, and you will see the details of that also below your screen. And it is from the 9th of November 2020 to the 28th of November 2020. It's a 3 weeks masterclass where you are going to be studying directly under my mentorship in that case. So thank you very much, and I'll catch you same time tomorrow. Ronnie, Rose, Uche, Samuel, everybody, Abiodan, Dachinine, Ario, Mavis, Joy, and everybody who joined the stream. Thank you very much, and I'll catch you same time tomorrow. Until we meet tomorrow, stay blessed and stay safe. Bye-bye.